Alex was talking about volatility in the bond markets. You look at the VIX, and right now it's just under 21, certainly above its year-to-date average of about 15. It feels like when we're looking at volatility in the equity market, there's like two regimes, pre-August 5th and post-August 5th.
Yeah, you're totally right. And August 5th obviously being that VIX spike where we actually hit 50, even 60 on an intraday basis. You know what I would say is when you look at the narrative of the first half of the year compared to the second, the first half of the year, I'd like to say, was all about the FOMO and the MOMO. People were using call options.
Wait, Scarlett wants to know what MOMO is. I think it's momentum on, momentum on.
Momentum,
okay,
yes.
That's what I thought.
Positive momentum, the FOMO, the fear of missing out, and all of that was reflected in call options. Now, we're really focused on the downside to a degree that we really haven't been since post-COVID. That really inflected started August 5th, and it has not gone away. That worry remains.
So how does that wind up impacting the overall market? If we're looking at a lot more puts than calls, so we're looking at downside rather than just selling the S&P, like how does that get reflected?
One, it simply just gets reflected in the VIX, and you're sort of seeing that because, we kind of call 20 that psychological barrier, 20 being high. Of course, it can go higher, but 20 really starts to indicate the overwhelming nervousness in the market. The second thing that I would say is it reflects a pickup in hedging demand. So some of that has to do with positioning, Alex. Just simply people are more long than they would be to start the year. There's more of stuff to protect. But second, I'd like to say the tails are fatter. And what do I mean by that? The low probability of something super bad happening, that has risen. That's risen with geopolitical risk. It's risen with these hurricanes we continue to talk about. It's risen with the inflation story. And all those fat tails kind of get baked into these positive put skew environments where that hedging demand has risen.
You talk about investors wanting to seek protection. Protection in what trades? The AI trade that served them so well in the first half of the year?
So that is part of it. I would say when you look at where the hedging demand has been on the upside, it's been in energy because energy has tended to become the geopolitical proxy. So upside in energy is actually a geopolitics proxy to the escalation in the Middle East. Now, when we talk about AI, we actually start to see that in individual names. My favorite one to talk about is in NVIDIA, obviously. The OG of all AI trades. But again, the first half of that year, the narrative was so unbelievably focused on call options, it kind of felt like it would never go away. And if you actually look at the chart, the severeness of that inflection is really telling because it's much more bearish sentiment. People are really concerned about this earnings season. It's become more of a show me on an idiosyncratic basis.
So talking about earnings, what kind of positioning do you see in the options market related to individual stocks when they report?
So, one thing we like to look at is the idea of what earnings day implied volatility compares to historical 8-quarter average. So just simply on
that was totally my question. I just said it differently. Yeah.
So simply put, what does that ratio look like? And one thing we think is going to happen this quarter is you're going to start to see beats to those 8-quarter averages. One, because this tends to be a relatively important earnings season. And two, because this October timeframe from a seasonality perspective is one where volatility tends to outperform anyway. And we've already seen that, right? That's already started to happen. We think we get more of that from a magnitude basis this earnings season.
Let's talk about macro because we got the Fed minutes, which showed that there was a lot of debate over just how much the Fed should cut rates by. And it seemed like Jay Powell was definitely leading the charge on 50 basis points, even with some reluctance, some discussion among his colleagues. How does that play out in equities and options, and in particular with the conversations you're having with clients?
So one thing I would say about that whole time frame is, so the next Fed decision is November 7th. And what's 2 days before that? U.S. presidential elections. So, I've had folks tell me, look, this whole thing is a sell the news, sell the vol event. I disagree in this situation because what I keep asking is, let's say we get to November 7th, we still don't know who the president is because it's so tight that we're still counting ballots. And then the Fed has to go and make a decision. To me, that's a recipe for a big volatility pothole. And so when we look at the money straddle, so the put and call option, just simply that magnitude, that's pricing about 2 to 3 standard deviations outside normal, even taking into account that it is U.S. elections. And that tells me people are kind of worried about the conflation of events, not just simply one or the other.
So what's the cheapest way to then hedge yourself?
So I will tell you, everything's gotten a little bit pricier, which is not a bad thing because often it takes that first kickoff in volatility to make things start to price that realized volatility. S&P put options on a historical basis still look okay. VIX call spreads still look okay. And then again, if we're talking about much more specificity, so risk around geopolitical risk, energy call spreads are interesting, and XEG and XOP, those type of ETFs.
Are there any risks you think people are not pricing in sufficiently right now?
So a longer term risk that, there are two actually that I'm concerned about. One is when you think about the hurricanes and just the displacement of people, one, what that actually means from elections themselves. So meaning physically, what happens on election day for people who are not going to vote because they're physically not going to vote. I think that's interesting to consider. And the second is the longer term implications of what happens with inflation, given these scenarios that are literally just playing out right now. Those would be my longer term questions.
The Middle East or the hurricane or anything like that.
Well, also just think about the fact that like people's home insurance is going to skyrocket. And we see this again and again. A lot of insurers don't even cover areas of Florida. I was reading an article that said like someone wanting to desperately sell their home and they can't for all the reasons. Or in California or
just being uninsured now.
Right.
Like not having the tail protection is never that great.